its second edition, the ET Markets pre-budget meet brought together market and industry experts to discuss the agenda for the financial markets in view of the union budget. The evening began with a panel discussion consisting of some industry titans.
The corporate earnings that are coming out so far have pleasantly surprised some of us who have been probably or led to believe or probably believed that the economy has collapsed in the last 2 months. So let me just go across and ask each of the panelists that the Indian economy and the Indian corporate sector far more resilient than we ever thought and than we ever gave credit to. Dr. Goenka, if I could start with you, sir.
I think in this case, it's not so much about the businesses being resilient, it's more about the consumers being resilient.
Sure.
And on November 8th, I never thought the effect will be as much as it was. Today, I didn't think it will recover as quickly as it did from that. So if I was to look today, I think we are probably about 75–80% recovered from the effect of demonetization. And that has happened because consumers are very quickly getting confidence back and seeing the inconvenience of demonetization in stride, right, and saying, okay, fine, it's a short-term pain for a long-term gain, and we have to accept that. And I must say that businesses also have worked and pushed on many levers during this time to try and recover from the short-term effect of demonetization. So my guess is that by 1st April, we would forget that there was such an event in terms of what it did to our short-term impact, provided
right,
the budget helps.
Very interesting point made by Dr. Goenka. Consumers are resilient. One of the sectors that we thought will actually collapse is the real estate sector. And everybody is talking about how, there are no sales happening, no inquiries, registrations are down. Mr. Hiranandani, you could give us a correct picture of what's really going on. Consumers as resilient as Dr. Goenka is saying?
I would say that in the initial stages, there were no inquiries. So I would say the first 30 days was actually not as cold as today, but colder. So, I think that really was something which shook up everybody, whether they were good, bad or ugly. But in the last 2 or 3 weeks, we do see a huge number of inquiries coming back. Mm-hmm. So the resilience of the consumer is certainly there, and I think it's coming back more than I expected.
Right.
So I think that's a positive sign as far as the economy is concerned. But I see a major other variation which has taken place.
Sure.
And that, according to me, is that earlier you would say real estate is doing well. That story is over. The real estate is doing well for some people, okay, right, for others, and badly for the third, which was not so earlier. So you would get people who have been so badly affected by the demonetization, right, that they are not able to pick up their heads. Right. In fact, they've sacked thousands of people, are out of jobs in these companies. We see that those who have been over-leveraged and have not been able to tide over the crisis are actually in soup, and you're going to see a lot of problems, especially because RERA is coming in. Right. So a combination of they're already being over-leveraged, a combination of demonetization with RERA in the offing, right, a combination of three is going to see the death knell of some of them. Right. But which only means that you're going to see a lot of restructuring, a lot of M&As, a lot of shake-ups is going to take place, which we will have to go through.
Right. Let me go to Mr. Anand. Very tough 2.5–3 months for you. But what is the common theme that we are seeing now from both Dr. Goenka and Mr. Hiranandani? Consumer resilience. What is your picture? What is the picture that you have?
I think a good way to look at that is the number of bureau inquiries. Customer comes to us, we go to the credit bureaus to check his sort of credit history, so to speak. In the middle of November, that number was down about 30–35%, right, over November 8th. That number came down to about -15% by December 20th. Mm-hmm. When I last saw the number yesterday, we're actually up +5% over pre-demonetization.
These are inquiries.
These are inquiries, and will almost always, sure, when you ping the credit bureau, it is fair to say that yes, it will convert into loans. And what is certainly up quite a lot is personal loans and credit cards. So it's really the smaller value consumption, right, which is now back in action. And as Mr. Hiranandani was mentioning, Yes, I think on mortgages and LAP, I think things will take a little more time before they go back to normal.
Right. And are you seeing the prospects of retail credit growth, which was actually quite booming before November 8th? When do you see that actually coming back to the pre-November 8 levels?
I think if you look at both November and December, the fall, typically the industry has been growing at about 18-19%. That came down to about 15-16%. So the point that all of you have been making, that the consumer has been resilient, is indeed playing out. So for the retail credit to go back to 18-19% is not going to take too long.
It's not going to take too long. Mr. Sinha, if I can bring you into the discussion now. Story for you probably is not so much consumer resilience, but consumer flexibility and adaptability. And what kind of changes are you seeing given the digital push that the whole country seems to be going through, and you are bang in the middle of this digital push? How flexible are consumers? How are they adapting to this?
We've seen consumers across the board, ready to adopt newer methods of payments. The number of people who've downloaded our app, or the number of people who've started using cards, these facts have been well reported.
Sure.
I think that the industry, which is merchants in general, and us, we've had to innovate at a very rapid pace to be able to enable consumers. And we've seen the industry respond to it. We've seen many merchants who integrated digital payments within 2-3 days, and these are massive organizations with dealer locations spread across 200-300 cities.
Right.
And of course they were feeling the pain in the short term, but that sort of mission critical approach to integrate payments, we saw that demonstrated consistently across sectors.
Right.
And we saw consumers then actually start transacting, and not just one instrument but across instruments, across wallets, cards, everything. And we saw volumes go up. So what we saw is that the consumers in general are ready, and what holds back from further digitization is the speed of innovation.
What about credit growth? There is a lot of talk that credit growth, since it has collapsed quite a bit, is going to take a longer time to recover because, well, Indian companies don't have money to spend, or they're already burdened with debt. We saw that retail credit growth has been very strong, and that's probably going to come back. What are your expectations of corporate credit growth?
So you've got to look at this in the context of even pre-demonetization. It was not as if credit growth on the corporate side was booming. And I think one of the big issues that we've had as an economy was private capex.
That's right.
And I think perhaps demonetization has delayed that a bit more. So in that sense, what was the situation with private capex pre-demonetization continues on the other side as well.
Right.
And like I just mentioned to you, retail I think will bounce back much faster.
Bounce back because...
Could I make one small point on the digital transaction? I think one of the derailers that needs to be fixed, and I don't, my budget will do anything about it, is the cost of digital money transaction, I think, is too high.
Right.
And most folks, when I talk to people on the shop floor or in the field, they say, "Saab, 1.5% lag jata hai, 1.5% bahut zyada hai." So how do we bring it down, and maybe you can throw more light as to how the 1.5% can become 1%, 0.5%, 0.2%. I think that's going to make a very big difference, because in India, people will not want to spend 1.5%, 2% for transactions.
That's right. That's actually a very important point, Mr. Sinha. If you could come in and, these transaction charges, there is a lot of talk about it, and if you really want to push digitization, you need to bring the cost down. So how does one get down to doing that?
Two things. I think first is, I think the Wattle committee report lays down in a great deal of detail how that can be done, and the right way to do it and the sustainable way to do it is to regulate interchange. Is to regulate how much one party can charge, one financial intermediary can charge another when a consumer is making a payment.
Right.
That's the thing that drives up cost. The wrong way to do it is to put a cap on it, because that doesn't solve any problem. So I think in general that's the way to do it. I'd like to see some of that implemented because it's good for everybody. And it's the sort of thing that would create scale in digital payments. Where I disagree a little bit is that I don't believe that the cost of digital transaction compared to the cost of cash is significant. And let me explain why.
Sure.
I often go to a small shop and buy something, let us say, for 27 rupees. And the shopkeeper gives me 20 rupees and or 25 rupees and some toffees which I don't want. And what in effect has just happened is I've paid transaction costs of 10% or 8%. And so I think that this thing that there is cost in the system is actually not a true cost. It's a mindset.
Right.
And I think that as digital transactions take off, merchants will actually see, or merchants and consumers will see that that's not a real cost. Right. Compared to the other costs that are there in the system. And I think the second thing is that there is some role, of course, that the government has in terms of hastening that education by bringing in certain incentives or, frankly, disincentives in case of cash.
What are the one or two things that you think that Mr. Jaitley should focus in the budget? And Mr. Hiranandani has talked about housing, talked about infrastructure. What are the things that you think Mr. Jaitley should focus on?
A systemic push for internet across the country, including in villages. That to me is infrastructure. And it'll create the innovation for tomorrow.
So they're already doing that. The digital broadband and the nationwide broadband project is probably aimed at doing.
But I think we need more. We need enablers, and it needs to be done tomorrow. Not like laying the broadbands. The smartphones are already there.
Right.
The telecom companies. The right incentives and push needs to be created for the telecom companies to do it tomorrow, not wait. 2 years.
Absolutely. Dr. Goenka, your thoughts on the budget? What do you think?
Well, what I would say very quickly is that in the short term, the economy certainly is dislocated.
Right.
So the budget has to bring it back on track, which means consumer confidence has to come back, and some things, maybe cosmetic, have to be done in the budget to bring consumer confidence back, and it may just require cosmetic, doesn't matter, but has to be done. And the investment climate has to come back in. Right now, investments are very low. Confidence is shaken, so that has to be taken care of. And one more thing that kind of has been said by Mr. Sinha is that we have started a move with demonetization towards digital economy.
Right.
Budget must reinforce that. Budget must reinforce that in a way that we don't take a step back now.
And go back
and
to
we keep pushing on becoming more and more digital, keep pushing on having a very large stick against black money that doesn't reappear. We keep pushing on people wanting to or not be incentivized to hide their income. These things which are part of the puzzle that has been started have to be continued with the budget, and budget must reinforce that.
Budget must reinforce that. Rajiv, do you think the government will go in for some kind of tax on cash transactions or cash withdrawals beyond a particular level or a limit, say 3 times a month or something of that sort? Do you think is that a good way to do?
What I'd certainly like to see is incentivization of digital payments, both for the merchant as well as for the consumer. And I think that I'd rather use that approach rather than the disincentive for cash. Great. We have time for some audience questions now.
How do you think that life will change post-RERA, and what is that could actually the RERA could bring on the table for real estate sector for its revival?
See, there are two aspects of RERA. The first is that there's going to be much more transparency in terms of the industry is concerned, and this is something which every consumer in India was worried about. So I think that is coming on the platform very clearly. The second part is that between the customer and the developer, the protection of the consumer is absolute in terms of an escrowing and putting at the art. On the negative side is the fact that there is no regulation which insists that the government agencies which have been so corrupt in India, that there is anything under the regulations to help that type of permission to happen. The second is escrowing the amount of extent of 70% is going to be difficult for a large number of companies which have been over leveraged already. So we do see a lot of plus points over a period of time, and for an investor, a new investor, it will be extremely positive in terms of growth. So you will see a lot of money coming into the industry which was not there earlier. But on the other hand, you're going to see a lot of existing players who are overstressed already really going to have a lot of trouble. So good and bad.
This was followed by an interaction with Aswath Damodaran, Professor of Finance, Stern School of Business, NYU, who joined the event from New York.
We are staring at what could be called as extraordinary circumstances, extraordinary in all regard. We don't know where volatility, how trade barriers, how flows would move. But equity markets globally have been quite resilient. What explains that?
The biggest lesson I get out of 2016 is to not listen to the experts. So if you think of me as an expert, my suggestion is to you that you don't listen to me. What you're discovering in hindsight is all too often experts have no idea what's coming at them, and there's a simple reason for that, I think. Financial markets are incredibly complex instruments where hundreds of variables go in to determine what happens. So when you devise a forecasting model that claims to forecast what stock markets will do, all you need to do is get one variable off and your entire forecast is going to be thrown off. So I think that what we're learning is forecasting what the market will do will be really tough to do. And I would take that lesson in as you talk about the Indian budget, because there are two levels of expectations, right? One is the expectation of what will come in the budget, and then there's a second layer of what will happen to markets once the budget is announced. And you will of course hear people telling you that they know what's coming, but my suggestion is you take it with a grain of salt.
There is a belief that American economy will make a comeback, taxes would be lowered, and corporate America will have better cash flows. What is your understanding of the new Trumponomics?
I think 2017 is going to be a year of change. I think that's absolutely true. And I think change is coming to the U.S. economy. We just don't know whether it's going to be good change or bad change. One of the things I've learned about the U.S. is making big policy changes is always a lot more difficult than talking about it. So we can talk about tax law changes, but by the time the changes actually get made, they often don't resemble what the original expectations were. So I think it's true that you're going to see a pickup in the U.S. economy, at least in the short term. But that pickup is going to be as much a reversion back to the norm in terms of expectations about inflation. Nominal growth is going to pick up. And real growth actually was pretty healthy last year. So if nominal growth picks up and real growth, stays where it is, you're going to see interest rates go up in the U.S., and that's going to have a ripple effect across the global economy.
Recently seen that the historical correlations are also breaking. Markets were supposed to fall after Brexit. They were supposed to crash after the Trump victory. The historical correlations for the moment are getting challenged. The cost of capital in the world is moving up, and yet equity markets are rallying. So what's going on?
I'll tell you something that surprises people. The cost of capital for a U.S. company has not changed that much over the last 10 years. And these are 10 very eventful years with all kinds of crises. It seems like investors are a lot more sanguine, a lot more settled than the experts who talk about those investors. So when you hear people talk about catastrophic forecasts, if this happens, the whole world is going to come to an end, my suggestion is that you kind of step back and look at the big picture, maintain perspective, because the big picture is often a lot more settled than the small parts of the puzzle.
How would you value some of the companies, the FANG stocks, the Ubers, and the other unicorns which are commanding billions and dollars of valuations?
So let me step back. I don't think most people who invest in these companies, whether it's the Flipkarts, the Olas, or these young tech companies, really value these companies. They price them. What I mean by that is they set a number for these companies based on what other people are paying for similar companies. So with these companies, rather than think about why their value is changing so dramatically from period to period, we have to think about why their price is changing. And price changes because of things which are not fundamental. It's mood, it's momentum. I think, at least in India, these companies are now coming to what I call a bar mitzvah moment, which is a moment in which they're going to be asked, are you growing up? And that's going to be the test for these companies. is they've had lots of promise, lots of potential. People have invested in them. I'm not one of those who points fingers and says, you're being crazy, you shouldn't be investing in these companies. But these companies now have to show us that they can actually deliver revenues and earnings and cash flows. That's a tough test. And I think that we're going to find out which of these companies really have a business model to convert what they see into earnings and profits. So I'm going to keep my mind open to the possibility that some of these companies could become great companies. But it also means that you're going to see those prices that investors are paying for these companies swing around a lot as people's perceptions about these companies change.
Professor, what is your view on Indian IT companies? Because Indian IT business has now become more like a matured business. It reminds me, like you once said, that Indian IT companies have become like old manufacturing companies in US.
One of the things I tell people is, 30 years ago when I said tech company to you, you probably thought high growth. We attach the word tech to high growth almost automatically. The tech sector is aging. It's no longer a young growth sector. In the US, tech companies account for more than 20% of the market cap of the entire US market. They're no longer a small part of the economy. And I actually, a few months ago, broke down tech companies by age. What I did was I took the year in which a tech company was founded, and I looked at how the market was pricing tech companies. And here's what I found. If you were a tech company that was more than 25 years old, you were being priced at levels much lower than non-tech companies. In fact, I describe tech companies as aging in dog years, which is a 20-year tech company is like a 140-year manufacturing company. A lot of the older Indian tech companies are aging. What does that mean? Well, if you're an investor in these companies, don't expect double-digit growth. Don't expect the margins used to historically, because as companies age, those things are going to be more difficult to deliver. So I think that we have to start bringing down our expectations for these companies. They're not small companies. They're in competitive marketplaces, and they're going to start behaving like older companies rather than younger companies.
Professor, what is your view on Indian markets? You know, last couple of years have been good for Indian macro per se, but Indian markets have not given very handsome returns. Is there a disconnect in the world in the way how markets and economy will move?
I think so, and I think this is happening globally. There was a time 20 years ago where if you told me how your economy was doing, I could predict how your markets would do. Today, we're all connected at the hip. This is, I think, the flip side of globalization. And increasingly, what happens in a market seems to be disconnected from what happens in the economy. I mean, take the US, for instance. Over the last 10 years, the economy hasn't done very well, but markets have done really well. So I think that's the first thing to recognize, is there's a disconnect between economies and markets, and that's coming to India as well. The second is how well markets do is a function of where they begin. So if you start from a low point for markets, it's so much easier for markets to do well. If you start from a high point, it becomes much more difficult to climb the mountain. So given where Indian stocks are, it's much more difficult for them to deliver 20 or 25 or 30% returns because they've had a few good years behind them. So I think I think we all need to get used to the fact that predicting economies doesn't make you a good investor. That thinking about markets and how they will do requires a different skill set than thinking about economies and how much they do. So we're waiting for some massive stock market effect from the budget. I think that's a mistake. I think markets have already factored in what expectations are, and those expectations are already in prices, so expecting major changes to come about just because you see an event, I think is unrealistic.
So, Professor, we got the gist of the way you're trying to summarize the world, and thank you for joining us. Appreciate your time. Audience is delighted that they got to hear your views. Before I wrap, I would like to thank our sponsor, IRB Infrastructure, for sponsoring the evening. Thank you very much for making this event a success. Thank you.